Good morning and welcome to Zicklin Talks Business. I'm Bruce Weber, the Willem Quaker Dean at Zicklin School of Business, and I'm delighted to have you with us today for a timely and thought-provoking conversation. For generations, public accounting firms have been built on a partnership model of governance and ownership. The model reinforced professional ethics that safeguard firms' reputations, and those are rooted in independence, transparency, and client trust. Yet today we stand at a crossroads. Private equity firms are increasingly acquiring ownership interests in accounting practices, and this development raises profound questions. What changes when a private equity firm enters a profession historically defined by partnership and stewardship? How do private equity-backed firms reconcile investor expectations for returns with the profession's core values of independence and transparency? Can an accounting firm maintain its culture, professional standards, and client trust under PE ownership? These questions go to the heart of how professional services are delivered, how reputations are sustained, and how the next generation of accountants will navigate a landscape where financial capital and professional ethics intersect, sometimes uneasily. Our distinguished panel will explore these tensions. They will examine whether private equity can be a catalyst for innovation and growth, or whether it risks eroding the trust upon which the accounting profession and other professional services are built. Larry Zicklin, class of 1957 here at Baruch, will lead the conversation with Professor Robert Knechel and Shiraz Kaji. Professor Knechel earned his PhD at the University of North Carolina, Chapel Hill, 1981, and has a BS in accounting at the University of Delaware. At the University of Florida, he directs the International Accounting and Auditing Center and is distinguished professor and Frederick Fisher Eminent Scholar in Accounting. Shiraz Kaji earned his BBA here at Baruch in 2002 and an MS in 2003. He is the Chief Financial Officer of SLR Capital Partners, a private credit-focused asset manager. We'll reserve time at the end for audience questions. Please submit yours via Zoom's chat feature to my colleague, Associate Dean Gwen Webb. And now I'll turn it over to Larry Zicklin, former CEO and chairman of Neuberger Berman, and a valued member of our MBA and undergraduate honors faculty. Larry, the floor is yours.
Thank you very much, Bruce, and thank you to our guests, Robert and Shiraz. I don't know that there are any particularly good numbers associated with private equity investments in public accounting firms, but I've heard the numbers that over the last 5 or 6 years, someplace between $30 and $50 billion have been invested in the various CPA firms. Is that a number that you recognize? Does that sound right?
Yeah, I think so. I've heard sort of similar lines. It's all the investment in the space has come in probably over the last 4 or 5 years. And I think, the stats are something by the end of this year, about half of the 30 largest firms in the US will have some sort of private equity investment. And I think that number, after the couple of transactions that are probably pending right now, will probably be closer to 80 or $90 billion.
Really?
Yeah.
So private equity is now part of the profession. Is that fair? I
think that's fair to say in the US for sure. And this is primarily a U.S. Phenomenon. It hasn't yet. It's starting to expand internationally, but it's not quite there yet.
There have been some transactions in the UK.
Yeah,
but that's the only other place I really know of any happening.
And do you have any idea what prices the accounting firms are getting for these partnership interests by private equity? I mean, I've heard numbers like 15 times EBITDA.
Yeah, I think that sounds about right. I've heard low teens, so I'm guessing 13 to 15 times is probably the right multiple on an entry point for most PE firms at this stage.
Since private equity firms want to make returns that, quote, I'm quoting them to their clients, are above average, what does that portend for accounting services in the future?
Yeah, I think there's, from a return perspective, private equity firms are, when they look for an exit, it's sort of, one of two ways they're going to make their money, right? Either EBITDA goes up or the multiple goes up, either one of the two, right? And that's where they make their return. I think for the industry, for the profession, which has been around for a long time. That that's going to require growth. That's going to be organic and through M&A. My guess, the biggest sort of impetus for some of this deal activity has been the roll-up strategy of sort of buying one firm and then buying much smaller firms and combining them into the bigger firm, making them even bigger. So I think that's going to be a big part of it to sort of reach those return targets. And then there's going to be expansion, whether that be international into other business lines. That's going to drive sort of the drive the firms going forward.
Larry, before we get too much into the weeds on this, can we talk about why this is happening now a bit?
Yeah, I was going to do it in a little later on, but I'm perfectly happy to do it now.
Because I think in order to understand what's going on, we need to understand what the forces at work are here.
Happy to talk about it.
Yeah, I'm gonna let me, if you give me a minute, let me read a quote. Our alternative practice structure responds to the needs of middle market segment of the profession that seeks to maintain and build firms that can provide high quality services in a changing environment. Accounting firms, and especially middle market firms, are unquestionably under intense pressure to generate and attract capital. Accounting firms today must have access to capital for personnel, training, technology, and operations. In other words, there's a lot of economic forces at work. Interesting.
Well, are these forces different than the forces that were at work 10 years ago?
Well, I was just going to finish. The interesting thing is this is a quote about American Express alternative practice structures in the 90s. So while this is not new, I think what is new is the fact that it's blatantly PE, private equity, rather than corporate. Now, American Express had this alternative practice structure back then because they wanted to be able to supply accounting services through their high net wealth investor management division. So they did some of these things. They had a slightly different business model. But the point is that there's this, these forces are not new. They just are accelerating, and possibly have we reached a perfect storm where the firms just need capital. They spend billions of dollars to finance their technology developments and their methodology developments. They need to spend billions of dollars for a partner retirement overhang that is unfunded, and they need billions of dollars for talent attraction and retention. And so all those issues have been in the past, but they've never been on the scale they are now. And so what we're seeing is where does that kind of money come from when you're working in a partnership structure? And so I think this is very important to understand that something has to give. Right now we're talking about private equity, but it could, I agree, in 5 years, it might be something very different because at some point, whether it's the regulators or lawmakers or somebody's going to realize, actually, if you want this profession to keep moving forward and don't want it to be taken over by the idea of short-term private equity, that we need alternative business structures for these kind of professional services to be able to operate.
But historically, partners retired. Technology came into being. I remember when the first computers came in and the accounting firms had to finance those. Why is this period so different from historical periods?
Well, again, I think I would say it's because of the matter of scale. Basically, if you even go back 20 years ago, my guess, I don't have any statistics on this, but partner earnings were much lower. And if you're retiring on a multiple of your last 3 years or something like that, then the numbers are just bigger. And then the other things, we all know what's happening with investments in AI, but it's not just AI, it's blockchain technology, it's data analytic technology. There's just, before we had to buy laptops and install Excel. That was the first wave of this. Then we moved into data analytics, which was using basically the same technology platform, but just a different set of software suites. Now we're seeing some really structural changes in the way technology could, in fact, influence professional services and accountancy going forward. And AI is something that we've never had to encounter before. Just look at the money pouring into AI in the basic capital markets.
I think it's the scale and the pace of that growth that's sort of driving a lot of the impetus to do it now.
I would agree with that.
And so you think this, I'm going to call it an onslaught, will continue, and there'll be more and more private equity investments or other kinds of investments, eventually reaching the big four?
Well, I think there has to be, because, I mean, if you took the traditional partnership, where do they get their capital from? They get it from partner contributions, which there's only so much you can get out of those, out of the partners. You can't really retain earnings because it's a tax flow through entity in most cases. And you can't really borrow any money because they don't even own buildings anymore, it seems like. And so you don't have any collateral. So where else can you get that kind of infusion of capital? And one thing I understand firms are doing is long-term, for lack of a better word, I'll call it a joint venture or a license arrangement, where in order to develop some of the technology, they're partnering with a technology firm. In return for the technology firm doing the capital investment, the accounting firm is signing long-term licensing agreements. That may be an alternative structure particularly for the big four firms, where it's not clear how private equity would work there anyway.
Mm-hmm. Yeah, I think it's interesting to see how it develops. I think EY tried this a couple of years ago. They tried to split out the consulting business and take that public to generate liquidity for the partners, and generate capital for the partnership that remained. That failed for a couple of reasons. One, the market turned against them when they were trying to do it, and two, the partners sort of didn't vote for it. There was sort of a revolt internally. When you have that many partnerships in the dispersed sort of ownership group, you're out at the mercy of everybody's vote. So they tried, and it didn't go well. Now I think it's going to be. We'll see how the PE firms actually exit these investments in public accounting firms, because that's going to be an interesting decision. Do they decide to take some of these companies public? Do they sell them to other private equity firms? Do they sell them to bigger platforms like a Big Four? That's going to be interesting to see, because I think that would sort of drive what the Big Four end up doing as well.
A lot of, I think what's driving this is the realization, and this is what PE can do, is that accounting firms are very, very hard to manage. I mean, they're big, they're sprawling, and it's a partnership structure. So, you would almost argue that, trying to run a partnership is like trying to herd cats, right? Because every partner, it's like an academic unit. Every person has their own opinion and their own vote, and they're going to do, say and do what they feel is the most thing. And I would refer to, there's a paper in 1983 by Fama and Jensen, where they talk about why a partnership structure is appropriate for certain organizations. And the two characteristics they list as being, which would cause a partnership structure to be most appropriate, is that technology does not involve important economies of scale. That's not the accounting world. Second of all, demand for resources to acquire risky assets is low. Well, that's not really accounting anymore either, because obviously these technology investments are dependent upon scale. So as we move into that world, the partnership structure becomes less and less appropriate for this type of business operation.
Just to stay on this subject for another instant, when the partners make a deal to get an equity infusion from a private equity firm, does that hasten retirement of partners who see themselves getting the money on the barrelhead and want to leave immediately? Are you seeing an acceleration of retirements?
I think there's a natural bubble of retirements coming up prior to these transactions. Definitely the acceleration of equity infusion into the business is probably driving some partners to that line. I haven't seen it directly, but I've heard of it, that some senior partners are taking the money and leaving. To put into context, the partnership, when a partner retired in the partnership days, they would sort of get a payout over 10 years usually. And every firm's different, but it's over 10 years of their 2x, let's say, their best 3 years at the firm, or something to that extent, over 10 years. In the PE structure, they get 3 times their money on day one. On average. I mean, it depends on the deal. But if you can not wait, you don't have to wait 10 years for your payout, and you're getting, instead of 2x, you're getting 3x your money. It's probably, if you were thinking about retiring, not a bad time to do it.
Sounds like a brilliant.
I've only heard anecdotally this is happening, but I think the incentives are all there, including the incentives of the PE people, to try to, streamline the senior partners or the senior structure of the firm.
But isn't it the senior partners that have the links to the clients? And aren't you giving up those very solid links?
There's definitely that. I think, one of the big things when they look at purchasing these companies, these partnerships, it's, what do we have to retain from a relationship perspective? Because that is an important part to the industry and to the profession, that relationships between, client and provider, in this case, whether it be auditor or tax provider, is a sacred relationship. It's a give and take, and that's important. So I think they definitely do maintain that at the top of the house. A lot of deals come with keeping on senior management, senior people within business lines for a certain amount of time. It could be 3 years, 5 years, contractually to sort of, so they'll defer the payout. It will be 3x your money, but not on day one. Maybe it's half of that on day one and some over 5 years or at year 5 or something like that. So I think firms are cognizant of that. I know when I was at New Mountain Capital and they purchased Citron Cooperman in 2002, one of the big things there was to keep Joel Cooperman, who was the founder of that firm, still running that firm once they made that acquisition, for a couple of reasons. One, the relationships he had with existing clients, and second, for his relationships across the industry to other professional firms in the space that he could then potentially bring in as target investments for a roll-up strategy. So that was important for him to stay on, which he did until they exited the investment earlier this year.
Yeah, I mean, I would agree with what you're saying, Larry, in the sense that if you've got critical key large clients, you want those people staying around for a while. But not all partners are equal in that sense. Some are much more vital than others to keep. And a lot would depend upon what their options are. I mean, if I could take a 3 times payout today and then go sit on a couple boards or audit committees, that may sound like a pretty good trade-off.
It's not a bad gig.
Yeah.
For sure.
Am I allowed to join another accounting firm if I take 3 times payout today?
A lot of times there's non-competes. They will put that in as part of the payout for a certain amount of time. It's not infinite, but it does limit you, especially if you're at retirement age. It might be difficult to then join another public accounting firm, but not a industry. I mean, you could join a corporation for sure.
Does the accounting firm want me to join a corporation so perhaps they can become another client?
Yeah, I mean, accounting firms historically have loved retiring partners to join corporate boards. That gives them an in to the business, to the CFO. It definitely opens up channels for new business. I don't think that will ever change.
Maintain alumni networks, even with staff accountants to some extent. I mean, up until the time they disappeared, I used to work for Arthur Andersen way back in the dark ages, and they kept in touch with me yearly all the way up until they disappeared. Yep. So they think they value that alumni network.
Let me go back to my original question now. What influence will private equity have on the management of these accounting firms? Will they sit on the management committee? Will they have ultimate influence? Will they have just a voice? Where do they sit on the managerial hierarchy?
I think a lot of the deals we've seen thus far have been majority stake ownership purchases. So in that sense, they take over full control. Step one that I've seen so far in some of the acquisitions is the first thing they do is they split the firm into 2. They create an audit firm that's separately managed. That's usually the ownership of that is still maintained usually by the existing partners, with the private equity firm having a minority stake in that audit firm. And then the second firm, which is an an advisory or consulting firm that they create to sort of house the sort of higher margin, high growth businesses where they own a majority of it. And then they take over the management. They usually install, one of the big ads for PE firms to businesses is bringing discipline, making improvements, and institutionalizing, an accounting business that's been around for over 100 years and hasn't evolved much. So they bring in professional CEOs, CFOs, COOs to run that business on a day-to-day basis. So they're quite involved when they own a majority stake.
Yeah, the rationalization of corporate organizational structure really matters. I mean, a couple of years ago, I was doing some work for an international regulator, and that I was looking at a set of one particular organizational structure in a Big Four, and they had literally multiple thousands, 2 to 3,000 client-facing, revenue-generating legal entities globally. And so that suggests to me that you've got individuals in different countries running their own little fiefdom for their own purposes, whatever reason, and they try to instill discipline across this sprawling, loosely connected network where essentially you've got national level partnerships and then lines of business within each of these partnerships. This is not the way you basically scope out an efficient organizational structure, it seems to me.
So in the future, do you think we'll see accounting firms that own all these companies, these service professional companies in various countries around the world rather than outsourcing?
I mean, so it's been a sort of a loose global partnership for a lot of these firms. They maintain the name, and that's pretty much it. I think part of the thesis for private equity is to buy the U.S. firm and then to go out and look at the international firms. I think an example would be Grant Thornton. New Mountain Capital bought Grant Thornton in the U.S. Last year, and then subsequently they've now bought the Grant Thornton businesses in the UK, Netherlands, Luxembourg, Cayman, France. They're picking off countries one at a time and buying those, trying to create a sort of a global enterprise that's bigger than the US version. One sort of new twist in that story is that another PE firm came in, Cinven came in and actually bought Grant Thornton in Germany and the UK. So now you have two private equity firms that own the same brand, but in different jurisdictions. So that's interesting. That's a new twist. So we'll see how that develops. That just happened recently.
From a client point of view, how will the client react to any of this? How will their services change, if at all?
I would expect for existing clients, they shouldn't have a change in service, at least for the existing business that they give to the firm. I think what the PE firm is, trying to do is, make investments in technology, make investments in staffing, make investments in business process, which should hopefully make the experience from a client side much better, and then offer services beyond what they're used to receiving from the firms that they've done business with historically. So they should have, just a broader suite of products available to them because of the resources the firm now has.
And will the private equity investors who are always searching for an above average return, how long will it take them to get their money back? And in what form will that be? Will that be in the form of higher prices for the service?
Yeah, I think it depends. So the strategy is, buy these small firms, roll them up, bigger firms, and then exit. The exit could be, one of many ways. So far there've been just one exit, which was Zicklin, which is an exit earlier this year. That was a sale from one private equity firm to a bigger private equity firm. So we'll see how that evolves. Down the road there could be sales to bigger platforms. So it could be a sale to a big four or a bigger firm, or it could be going public, which is another option for these firms.
Was that sale at a bigger multiple, or was it a sale for higher profits, or was it a sale at a loss?
It was a profitable deal for New Mountain. It was a little bit of multiple growth and a little bit of EBITDA growth as well from part of the roll up. So they definitely did make some money on the deal. But for them, I think it was sort of the test run, right? So the first deal was Eisner, which is 2001. Zicklin was 2021, and then Zicklin was 2022. They held it for 3 years. It was a smaller company. They exited it, and then they went out and bought Grant Thornton, which is a much bigger transaction. So I think they used it as sort of a learning tool, which private equity, historically will do. They'll do a small deal, learn from it, and then kind of then go into the bigger deal. But they wouldn't do the bigger deal if it wasn't a profitable deal with a good plan. So I think it definitely worked out in their favor. And they added real value to that business. They added some new business lines. They bought a firm called Murray Devine, which is a valuation firm, which is had a good track record in the valuation space. They added that as a service offering. They grew some of their expertise at the industry level, specifically focused on asset management. And they outsourced. They added outsourcing to India and other areas where Zicklin historically hadn't invested in. So they built that out as well. So I think they've added real scale to that business. And it's going to be interesting to see what Blackstone does with that transaction now that they're a bigger firm with more resources than New Method.
I mean, you asked the question, what's the client going to, how they're going to react? Well, I would have to presume that they're going to get at least the same level of service and possibly better. I mean, otherwise, this is not going to be value creating.
But the assumption in that is that the service they're getting is subject to lots of improvement at the same fee. Why do I have a guess that fees will be increased as a result of this private equity investment?
Well, whether fees go up or not depends upon the market, right? I mean, you can't just raise fees on your own. There's a whole literature on audit fees and the nature of competitive markets for accounting services.
But isn't it almost an oligopoly that public firms, companies that are public, not accounting firms, have the big four as their auditors?
Overwhelming firms that have the scale.
Pretty much, yeah.
I mean, you can't. How are you going to grow a fifth big four, so to speak?
Mm-hmm.
I mean, first of all, the clients are already all locked into current auditors. So in order to grow that fifth firm, you have to somehow force a reallocation of clients, which I'm not sure legally how you would even go about doing that. But the other thing that I think is somewhat misunderstood, in economic theory, there's two types of markets. There's something, and I'll just bore you with a technical term, a Cornell competition and a Bertrand competition. And in a Cornell competition, you compete on quantity. In a Bertrand competition, you compete on price. Well, nobody's going to buy more than one audit a year. And so you can't compete on quantity. So you compete on price. And what that market looks like is you don't have the normal type of oligopoly pricing power you might expect otherwise. You can actually, in theory, get perfect competition with only two firms. Now, I'm not going to go so far as to defend that. But in the end, it's the scale that's necessary to service these clients. Why do we have big audit firms? Because we have big clients. Why do we have global audit firms? Because we have global.
And to put in the context, Larry, the fourth largest firm of the big four is KPMG, and their annual revenues last year were roughly $40 billion. If you add the next 5 or 6 firms below that, you don't get to $40 billion. Like, just take the next 5 or 6 in the row, and you don't even get to 40. So it's a big step up it's a big step down from the big four to the rest of the field.
I mentioned to you earlier that when I graduated from Baruch as an accounting major, there was a big 8, which became the big 4. Robert, you mentioned offshoring. Can you define what that is for our audience and maybe how this new world of private equity investment will affect offshoring?
Well, if you mean by offshoring, I'm not sure I mentioned this conversation yet, but it's a good topic because offshoring, the way I interpret it, is usually the idea is you've got a U.S. auditor with a U.S. client, but then they send certain types of work overseas to a service center.
That's exactly what I mean.
Yeah, okay. And so now these service centers are usually owned not by, so like the most well-known ones are in India. They're not owned by PwC India. They're owned by PwC US usually. So they are a direct report to the US practice. For example, I know one big four that has one in the Philippines, which is jointly owned by New Zealand, Australia, and Canada. And so you can do that because they're not serving clients directly themselves. So they don't have to comply with the local regulation about local firms, local ownership, and local services. And so they allow that to do that. And part of that is obviously that's a cost move to keep certain types of costs down. I've actually heard people argue that with AI coming along, those actually may come back onshore because AI, if you look at the idea of AI, it's often to bend the cost curve, that you can actually service more clients for less money, lower costs, which also leads to another potential serious disruption, which I think PE could help. And that is, there was actually an article in the Wall Street Journal last week about, has AI going to make billable hours obsolete?
Is AI going to make what?
Billable, the concept of billable
hours. I saw that article.
Because if AI can do it in nanoseconds instead of having 3 staff people do it in a day, and all of a sudden, what business is, if you save money, it just instantly gives it back to the client. I mean, that's not going to work. That's not the way, historically the firms have done that to some extent. But so the pricing model is likely to change too, which it could also be part of the underlying play in the private equity market as we move into the technology implications of what it means to service a client. And I think law firms are even ahead of the curve on this than accounting firms. But that's one of the reasons why I got off the topic of offshoring. But the offshoring is really all about keeping your average costs at a certain strike point, is what it boils down to.
Have we seen much of this in the legal business? Private equity investing in law firms?
No, not really. I don't think it's there yet. We have seen KPMG actually just added actually got approval to add a legal practice to their business. That's something they were trying to do for many years. So it'd be interesting to see how that actually develops. I think they just got approval earlier this year.
Right? Sure, that's the Arizona case.
Yeah, I think it was Arizona. Yeah.
And by the way, that's not new either. If 20 years before the PCOB came along, Sarbanes-Oxley, if you left the United States, pretty much every country in the world would have a legal practice in the accounting firm. I remember on the Auckland skyline when you fly into Auckland, New Zealand, and the first sign I would see is KPMG Legal on a big building, not just KPMG, but KPMG Legal. So in a sense, is there a natural economic synergy? There could be. And yeah, I saw that case too. That's interesting how that may play out.
Yeah, see how they actually execute on it.
One of my mentors used to say, after A comes B. A is for accounting. I suspect B is for law firms. But let me go back to accounting for a second, and for some of the students that we have at Baruch. What do you think the effect of all this new technology, AI in particular, will be on hiring of new accountants?
Yeah, I think it's always a fear with new accountants coming out that there could be something that's going to replace them or no need for sort of junior accountants. I think that's always been the case. I know when I came out over 20 years ago, it was the case. Back then offshoring was a kind of a new thing that was coming to market, and people were talking about how offshoring is going to take away the entry level accountant job. That didn't happen. I think what happened is everybody just kind of graduated and started from a higher level. If they were originally starting at a level 1, level work, they were now starting at a level 3 level work because the level 1 and 2 was offshore, right? In this case, if all the starting accountants at Big Four are starting at a level 3 and AI comes in and does level 3 and 4, they graduated year 1, they're already at level 5. So I think it's just a step up and an expansion of sort of the skill set for new graduates.
I agree. It's an educational challenge for us on that side of the fence to figure out what that skill set should be. I use in speeches a quote by the CEO of Amazon. He says, "We will need fewer people doing some of the jobs that are being done today and more people doing other types of jobs." Yeah, so you basically are moving up, I would call it the information value chain, right? The low value work can be done some other way, and you're moving the professional expertise to a higher level of value creation potentially. But that has some significant implications of how do you grow those people? How do you educate them? How do you get them up to speed from a training and expertise point of view? And there's a lot of questions there that I think we're going to still have to deal with.
We've been educating people, accountants, for so many years on getting to education, on getting to steps 1 and 2. How do you educate them now and change our methodology to educate them for steps 4 and 5? Doesn't that mean changing the whole educational curriculum?
Possibly. It's one of the reasons why you look at the hiring in the Big Four now, and they're hiring a lot fewer graduates of traditional accounting programs. They're now hiring engineers in IT and people in their information systems because they need a broad set of skills. And that's probably now you can talk about what's the complexion of a structure of an audit team going to look like, our client service team going forward. I think you're going to have a much more diverse set of skills. I mean, we used to work on the assumption that, well, if you take a well-educated accountant, you can teach them the technology skills. But I think we've reached a limit to how much we can do that.
I definitely think I know Baruch's working on it, and Dean Weber could probably talk about it a little bit more. But adding programs to accounting that are beyond just accounting, so accounting and data analytics. Accounting and something, adding on to the accounting. So it's still the basic sort of accounting. You still need to know the basic accounting, but then you have this layer on top of it. So when you're graduating, you're ahead of the curve. You're at level 4 or 5 already with some of the skill set that you need.
Yeah, one of the things we've done at Florida, since we're one of the original states that had the 150-hour rule, for about 10 years ago, we
Excuse
started
me, can you just
joint.
explain, Robert, what the 150-hour rule is for our audience?
Technically, the 150-hour rule means to be a certified public accountant, which the only thing that actually does is allow you to sign audit opinions. One of the things we've seen is fewer people taking the CPA exam because they don't necessarily need it. But the 150-hour rule says, okay, you take a 4-year undergraduate degree, and then you have to have 30 more hours. And they don't have to be in accounting. They can be in almost anything. And different states and different schools play games with that regulation. But that 30 hours is very rarely integrated with the undergraduate program. But so that you have to have that. And what we started a program, a joint program with, we call it ISOM. It's the Information Systems Department in the College of Business. And they basically get a joint information systems / audit master's degree. And those people are in huge demand. And they get paid significantly more than our traditional accounting graduates get paid. So I think Shrez is right. You're going to have to add on something somehow. Now, trying to change the direction of a university with tenure track positions is like trying to change the direction of a super tanker in the Suez Canal, I think, sometimes. So we're going to see, that's our challenges. We're going to have to deal with this too. The world's not just standing still for us.
And is all this new technology going to change the intellectual challenges for a young person in the accounting profession and just make them cogs in a wheel as they employ AI?
I'd like to think not. I'd like to think it just, it would enhance, those technology tools will just enhance their particular skills in analytics and financial statements. I think we still need the financial statements. People still need to understand them. So maybe preparing them then becomes automated, but the analysis around it, deriving the insight into what those numbers actually say is going to be still very much a human endeavor. But hopefully a slightly easier one with more tools available.
Yes,
my own view, but I'd be interested to see how it actually develops.
Exactly. I mean, there's some research out there that suggests that these systems can lead to de-skilling and disinterest. And but we've had that before. I mean, literally going back to the idea of spreadsheets, even Excel. These are transition issues, I think, because you're taking someone who's trained or educated in a certain way of seeing the world and asking him now to operate in a different with new tools, and they often don't have a full understanding of what those tools are or how to use them. I mean, let's face it, my students at the University of Florida, they know how to use ChatGPT better than I do. They are going to gravitate to that type of technical knowledge anyway. And then so as an educator, we're going to have debates as to what should we teach them about this? Well, they could probably teach us. I mean, we had the same debates when it was Excel and when it was enterprise resource plan software. Things like every time we have that kind of development, we have that debate. And then eventually it just goes away because it becomes part of the environment.
Robert, when a young person approaches you at the university and says, I haven't chosen a major yet, I'm thinking of accounting, what do you think? What do you tell them?
I tell them well, first of all, it depends on what they're interested in doing, but if you think of accounting as accounting 101 and computing earnings per share, you have no idea what accounting is. Because accountancy can be almost anything, right? There's an old cliche about how getting an accounting degree, you can springboard into almost anything in business or even in not-for-profits or whatever. I think it's still true.
And do you tell them to major in accounting, or would you tell them to major in something else?
Now, that's a good question. I'd have to think about that because I would encourage them. I mean, first of all, full disclosure, I was actually never an accounting major. I mean, I was for one semester. Because,
your secret is safe here.
Yeah, well, this was before Bruce was the dean at the University of Delaware, but I was basically contacted by the university and said, you have too many credit hours and not enough in any major. Pick one. So I picked I talked to friends and said, where can I get a job? And they said accounting. So I majored in accounting. But the reality is, I probably would, if I had done druthers, I would be English major. But so there's lots of paths that these students will go through. There used to be a traditional career path that came almost hardwired, where you go from undergraduate to graduate to staff accountant up through and progress through the firm. And our current generation, I heard it's a great phrase I heard. We no longer really have career paths. We have what they call career chutes and ladders. Meaning you go up for a while, then you change paths, and maybe you have to go down a little bit, and then you go up again, and you may go up and do something else, and you may circle back to the accounting firm. I mean, the paths through the accounting firm are much more diverse than they used to be.
I see Gwen in front of me now, so I guess we have some questions from our audience.
Yes, we do have quite a few, and to be honest, there's a lot of interest in the issues about new hires, entry-level positions, and I know you've already talked about it, but given the interest in it, I want to put at least one of them forward to you. For students and recent grads, is starting at a PE-backed firm likely to give us better technology and training opportunities, or would cost pressures make early careers tougher?
I think it's going to be interesting. I think they're going to have more available to them than they do today. I think that's just the model of private equity is investment in the business. If they're hiring and they actually go there, that's a good sign. I don't think they have to worry about costs, because if there was a cost issue, they wouldn't have hired. Right? It's sort of, if you're there and they brought you in, you're going to be there and you're going to have the tools you need. And now, being in a firm historically that was just a partnership, you kind of knew where the firm was going to go the next few years because it was always a traditional path. Here, the risk with a PE firm is you come in and you don't know in 3 to 5 years, when the PE firm is sort of done with its traditional sort of business building model, what is it going to do? So there might be some uncertainty around what the future of your firm is going to look like. But I think from a skills and tool perspective, I think you'll be ahead of the game in that you'll have those resources at your fingertips.
Yeah, I think one of the weaknesses of a traditional accounting degree is we actually don't necessarily instill enough business knowledge sense. We tend to focus, particularly we start off, how do we get an accounting major historically? We put them through accounting 101. They learn how to compute earnings per share. They decide they like doing that, and then they move on. Well, that's actually not necessarily the best way to attract someone who can be broad thinking, eclectic, and really understand business problems, 2 or 3 or 4 or 5 years later. Robert. And so that's, I think, I agree with what Shiraz says. Basically, you're going to get a better appreciation for the business side of what we do, probably faster.
Robert, I just wanted to add something. I found that the audit partner we had at my old firm was very valuable to me, more so than the consulting and the tax and all that work, because the audit partner understood the business and could tell me things I probably wouldn't have ordinarily heard.
Right.
So it wasn't on the report, but off the record, we talked. We would have lunch together, and I learned so much from him. So
how many years did it take that person to get to that stage?
Probably 15 years.
Yeah.
But
and I think one thing we can conclude is we need to get to these people, new entrants to that stage much sooner.
Yep. I would agree. I'm sorry, Beth, Gwen.
No, that's fine. Actually, there was quite a bit of interest in that particular question, but I think you've covered it pretty well. Here's a question that represents the question from the perspective of a partner at a smaller firm. What are the top 3 questions these partners should be asking a potential PE suitor before they even consider a deal?
I think you want to know what the PE firm, what the plan is. So, usually
what the partners in the small firm should be concerned about if they're considering this investment.
Yeah, I think picking the right PE partner is important. Not all PE firms are created equally. To put it in context, I think as of last count, there's something like 18,000 private equity firms in the country, and there are only like 15,000 McDonald's. So just to give people some context for how many private equity firms there are out there, they're not all created equal. So I think you want to partner or a PE firm that's going to come in that you can that can understand your culture. That's not that's going to provide real value to the business and not just, it's not just a cost cutting exercise, it's a growth exercise. That's going to be important to kind of glean that from the team that you're interviewing at the PE firm. Not to be crass, but economics are important. You need to know what the numbers are, and you need to know what the partners are going to get, not just what the leadership team is going to get out of the deal. So you need to really get your handle around what the economics are going to be of the transaction. And then you got to see what's sort of their plan for the future of the business, right? Once they come in, what do they intend to do, and how does that sort of align with your own sort of personal goals or thoughts around where you think a business should go? So I think those are important, and it shouldn't be something that's just a one size fits all.
Robert, anything to add on that?
That one's outside my expertise. I yield to the PE expert on that one.
All right. I want to switch now to questions that deal with perceptions about accounting firms. Are there any concerns in the profession about long-term implications of private equity investment, especially with regard when we look at what's happened in medical and healthcare professions? Are there concerns within the CPA profession about long-term implications of these private equity investments?
Yeah, I think just the idea of a PE firm coming in to buy an accounting firm brings up a few things, right? There's conflicts of interest that come up right away when you have a transaction. There are independence issues around audits that need to be done, and whether those could those clients be portfolio companies of said PE firm. And then I think there's just even beyond that, just the basic ethics of it. I know recently I was on an ethics training for the AICPA, and there's a professional ethics executive committee that has this on the agenda for this year to look at, something to think about at the AICPA, and what's the ethics around PE firms owning accounting firms. So I think it's definitely top of mind with the industry, with the profession around what's the impact of this. It's still early days, but it'll be fleshed out, I think.
Yeah, that I would agree with. I think the issue is the auditor independence question. If you're going to do audits in this kind of structure, it could get very complicated as to how to figure out what is independent and not. And then ethics, which is a more broader concept, also would apply. One of the things when I first started looking at this area, we didn't say it directly, but we hear about this idea that PE has a short-termism approach. They want to flip their investment in some period of time. And I had a pretty senior audit partner from a big firm tell me, I wouldn't be worried about short-termism. There's nothing more short-term than figuring out how I'm going to fund my current year partner retirements. That's pretty darn short-term too. So, we really have to understand the economic incentives. They're not always as clear-cut as we like to think they are based on kind of stereotypes. And so I would then echo, it all depends upon the deal. And I can't give you an idea of what is a good deal, but yeah, there's a lot of things that need to be discussed and agreed upon that could blow up. And it may not, it may blow up one deal, may not in another.
Shiraz, you talked about who your private equity partner is. And I was thinking that your private equity partner ultimately may not be the one you chose, because that private equity partner may sell out to another private equity partner, as Robert pointed out, was done. And suddenly you have a new private equity partner that you don't even know.
Yep, that's true. That first transaction is important because you have some control over that one. But yeah, any subsequent follow-ons or sales, if you're not an owner, you pretty much the private equity firm owns it and can then decide how to sell it. You do lose some control beyond that point.
Well, I think we have time for just one last question. And this one is almost hypothetical and kind of requires you to look into the crystal ball. Looking ahead 5 to 10 years, do you think PE investments in the accounting firms will be seen as having modernized and improved a profession, or as having undermined its professional ethos, or some combination of the two? So this is very hypothetical, but what is your take on that?
I think we'll see how it evolves with the current transactions. There's also, there's sort of a shrinking pool of sort of meaningful targets for private equity firms, right? Private equity gets involved in an industry, they learn a lot about it, they come in, they make investments, Then they see how the exits perform. When they exit the transaction, is it profitable for them? That depends. Then that will then decide whether they stick with it and go on to another transaction. So I think it's still early. We haven't seen enough exits to sort of lay the groundwork for sort of what the future is going to hold. But I do think private equity partners coming into the space, adding technology, adding some business discipline around running an organization. Those can only be good things for the long term.
I would tend to agree with that. I mean, there's going to be failures along the way, I suspect, organizational clashes. But in an ideal world, the idea that we have this external force who's actually rationalizing into a modern environment, the structure of a professional service firm, there's a huge upside potential there. Will it always pay off? I think there's going to be a lot of learning, a lot of bumps in the road as we learn to work through this learning process. But the reality is, go back to why this is happening. The nature of the professional service sector as a whole, not just accounting, has changed dramatically as far as the economics of the way they operate. And whether it's technology or something else that's driving it, it's still there. It's still going to happen one way or the other.
Larry, we are pretty much out of time, but do you have any closing words for us on this?
I have just one observation. People in the industry regard themselves as professionals, and they think of themselves as professionals. And it seems to me private equity investors, whom I know rather well, have no interest in professionalism. They have an interest in rates of return. And in some place, those two may provide, to quote Robert, some significant bumps in the road.
Thank you very much. I think we'll leave it there, although clearly there's a lot of interest in the questions and a lot of exciting developments that we're going to see unfold going forward. I'd like to thank you, Robert. Thank you, Shiraz, and thank you, Larry, for a really compelling discussion.
Thank you, and thank you, Robert.
Thank you. Thank you. This was very enjoyable.
Shiraz, thank you.
Thank you very much. Take care.